In 2001, one of the most admired companies in America collapsed so violently that it erased over $60 billion in shareholder value, destroyed thousands of careers, vaporized employee retirement accounts, and shook Wall Street's credibility to its core. The company was Enron. For years, investors believed it was the future of capitalism itself, a machine that could turn intelligence, innovation, and deregulation into unlimited profit. But behind the polished earnings reports, the magazine covers, and the billionaire executives was something else entirely. Debt hidden in shadows, fake profits engineered through accounting tricks. Executives selling fantasies while secretly cashing out hundreds of millions of dollars. And perhaps most disturbing of all, almost nobody wanted to stop it. Banks kept financing it. Analysts kept praising it. Media outlets kept celebrating it. Even when the numbers stopped making sense. Because Enron wasn't just a corporate fraud. It was a psychological operation performed on the market itself. A company that understood a terrifying truth about modern finance. If enough people believe the story, reality becomes optional. And well, by the time reality returned, the empire was already collapsing. The rise of Enron began long before the scandal. In 1985, Kenneth Lay merged two pipeline companies to create what looked like a relatively ordinary energy business. But the timing was perfect. America was deregulating energy markets, and deregulation created chaos, new opportunities, new risks, and massive gaps in oversight. Lay understood politics better than operations. He understood that when industries become complicated, the people who control the narrative often gain more power than the people producing actual value. Then came the man who transformed Enron from a pipeline company into a financial weapon. Jeffrey Skilling. Skilling wasn't selling gas pipelines. He was selling a vision of intelligence itself. He believed energy could be traded like financial securities. Instead of simply transporting natural gas, Enron would become the ultimate middleman, buying, selling, speculating, and engineering contracts across global markets. It sounded revolutionary because parts of it actually were. Enron built one of the most sophisticated energy trading operations in the world. Traders sat in massive rooms, moving billions of dollars in contracts. Investors saw complexity and assumed genius. Analysts saw rapid revenue growth and assumed innovation. The stock market rewarded the illusion aggressively. By the late 1990s, Enron's stock had exploded from around $20 to over $90 per share. But hidden underneath the growth was a dangerous problem. The company wasn't generating enough real cash. That distinction mattered enormously. Revenue was rising, but many of the profits existed only on paper. Enron used something called mark-to-market accounting, a system that allowed the company to estimate future profits from long-term contracts immediately. If Enron signed a 20-year energy deal projected to make $100 million, executives could book the expected profit instantly, even if the actual cash might never arrive. In theory, the method was legal. In practice, it became a machine for manufacturing fantasy. Executives could simply make optimistic assumptions, inflate future earnings, and report them as current success. The company became addicted to projected wealth instead of real money, and Wall Street rewarded them for it. Because during the late 1990s, America was intoxicated by growth stories. The dot-com bubble was expanding. Investors no longer wanted boring companies with stable profits. They wanted visionaries, scale, disruption. Complexity became a shield against scrutiny. Very few people fully understood Enron's financial statements. That should have been a warning. Instead, it became part of the company's mystique. Inside Enron, the culture turned brutal. Employees were ranked constantly. Those who failed to perform were removed aggressively. The internal philosophy rewarded short-term gains, risk-taking, and personal profit above stability or ethics. Money became the only language that mattered. And then came the structure that ultimately destroyed everything: the off-balance sheet entities. Andrew Fastow engineered a network of partnerships designed to hide Enron's debt from investors. These entities had complicated names like LJM and Chuco, but their purpose was simple. Move a debo, Leo Sin. Abilities away from Enron's balance sheet, so the company appeared healthier than it actually was. It was financial camouflage. Debt disappeared from public view. Losses were concealed. Earnings looked stronger. The stock price kept rising. And because the stock kept rising, the fraud became easier to maintain. That is the terrifying feedback loop at the center of many financial collapses. Rising prices create perceived legitimacy, and perceived legitimacy attracts more money, which pushes prices even higher. Success becomes evidence of honesty, until suddenly it isn't. The warning signs existed for years. Some analysts questioned the numbers. Journalists struggled to understand the company's opaque reporting. Short sellers quietly suspected manipulation. But betting against Enron was dangerous because the market treated skepticism as stupidity. The company had political influence, elite banking relationships, and celebrity status in corporate America. Fortune magazine named Enron America's most innovative company 6 years in a row. Innovation became camouflage for deception. Then, well, the pressure started breaking the system apart. In 2001, cracks became impossible to hide. Enron announced massive losses. Billions in hidden debt surfaced. Confidence evaporated almost overnight. Creditors panicked. Trading partners fled. The stock collapsed from over $90 to less than $1 within months. Employees watched their retirement savings disappear, while executives had already sold enormous amounts of stock near the top. The betrayal was, honestly, staggering. Thousands lost jobs. Investors lost fortunes. Arthur Andersen, one of the largest accounting firms in the world, was destroyed for helping cover up the fraud. And America realized something deeply uncomfortable. The entire system had incentives to ignore the truth. Banks earned fees. Analysts wanted access. Executives wanted bonuses. Investors wanted the stock to keep climbing. Everyone benefited from belief. Almost nobody benefited from honesty. That is why Enron remains one of the most important corporate scandals in history. Not because it was simply fraud, but because it exposed how modern markets can reward illusion longer than logic can survive. Enron understood that perception itself had become an asset class. The company sold complexity because complexity discourages questions. It sold innovation because innovation excuses confusion. And it sold confidence because, well, confident people are rarely challenged until the collapse begins. By the end, the empire that claimed to reinvent business had been built on hidden debt, manipulated accounting, psychological pressure, and institutional cowardice. But the deeper lesson goes beyond Enron. Every financial bubble contains the same ingredients. Greed disguised as vision, leverage, disguised as growth, and narratives powerful enough to silence doubt. Markets do not collapse simply because numbers fail. They collapse because trust fails. And once trust disappears, even billion-dollar empires can die in weeks. Subscribe to Money Cartel, because the most dangerous lies in business are usually the ones the market rewards first.